Howdy, Jacob here. Today we're looking at Lazard. So first thing, 5.68% dividend yield. It's in the capital markets industry, $3.1 billion market cap with a $3.8 billion enterprise value. It's like they operate as financial advisory and asset management firm all throughout all throughout the world essentially. So $2.06 billion in revenue to $2.8 billion, where since 2017 we're looking relatively flat. So we got what their debt situation looks like. So 1.1 billion in 2012 to 1.7 billion in 2022. What is that in relation to cash flow? Less than 3 year, their 5 year average, let's say, is 600. So that's just over 2 years, or it's under 3 years. Their long term 3 years of cash flow to pay down their long term debt. Their capital expenditures are pretty consistent, and they are very good at producing cash from operations. Payout of 172 million, which they can absolutely afford with a $600 million cash from operation, free cash flow 5 year average. Looks like their other uses of cash are really just buyback shares. So nothing wrong for a company like this as long as they buy back shares at the right time. But yeah, I think it looks like a cash cow. They produce a lot of cash and don't have much use for it outside of giving it back to their shareholders through buying back shares and dividends. So interesting view right there. As for the dividends per share, it was interesting. So their cash paid went from 360 million down to 172 million, and their per share dividends have actually increased only, and that's again because they're buying back so many shares. That I said this in the previous video, but dividends are done on a per share basis, and so if you buy back shares, your cumulative dividend payout is going to be less. Or if you keep it the same or increase it, it's going to increase a lot more. And so here, I think if I make a dividend assumption, I would say that they could increase that 3% a year and afford it pretty well, or pretty simplistically. Their revenue, it's been kind of wonky, but I would assume that they could have 2% growth on the revenue. Pretty good return on invested capital. I think outside of 2022, we're seeing the last 5 years 8.2, 13.3, 12.5, 10.4, 21.2. So you would, if this were a normal business, I think because it's capital markets, it's in the capital markets industry, it's pretty easy to have a higher return on invested capital because it doesn't really take capital to be an investment firm, essentially an advisory firm. There's not a lot of capital that goes into it. So that's how they're able to produce high ROICs and return on equity. And it also helps that they've been buying back a lot of shares because that's going to inflate your ROIC number, because our return on invested capital is based on the balance sheet, and the balance sheet, instead of the cash from operations coming in, going straight to assets, it's being paid out in a dividend and share buybacks. So I don't think I want to. If this were a normal company, not asset management, I'd probably inflate the PE a bit to maybe even 15, 16 area. But for me, I think a 2% growth business, maybe I'll do 13, just on the basis of them being able to produce a lot of return on invested capital if they do find something they're able to invest in. Otherwise, it's still a little bit under market average for conservatism, as I'm saying that they have just 2% growth. So if we go to margins, 13 is the average, 26, consistently higher free cash flow. I'd love to see that. Maybe let's assume 14 and 25 maybe. And then share buybacks. I wonder what they've been doing recently, but looks like they've been consistently buying back shares. So let's just do 2% buybacks. And interestingly enough, we're saying that the company needs to fall 7% to get us to a 15% return. I'll try to do an in-depth video on this company, hopefully in not too long. Um, Again, asset management firm. I'm assuming the thing that might be a little wonky is the P and price to free cash flow. Historical P and free cash flow might share that this is probably a little bit lower. But if we're looking at dividend companies, I mean, this is a great dividend stock. We're looking at a 5.7% dividend yield, and they can easily afford it with their free cash flow since their payout is well under 50%. I think if it's 170 million off of 600, I mean, we're looking at maybe 25 to 30% of a payout ratio for 5% yield. That's pretty fantastic. But until then, hope everyone has a good rest of their day, and thank you.